As of 10:08 a.m. Eastern Time on October 28, 2025, BigBear.ai, ticker BBAI, is trading at $7.08 per share, down about 0.28% on the day. The stock is choppy, having bounced between $6.95 and $7.13 already this morning, on volume that is tracking just about average. The immediate expectation for a stock like BBAI, especially one that has seen a 300% plus run in the last year, is that it's all about hype. It's seen as a pure-play bet on artificial intelligence, a name you trade for quick pops on your Robinhood app or SoFi Invest platform. People see AI and they see government contracts, and they immediately think of explosive growth, another NVIDIA stock in the making. The recent news of its biometric Veriscan platform being deployed at Chicago O'Hare Airport for U.S. Customs seems to confirm this expectation. A big, visible, important-sounding win. But here is the reality that the headlines don't capture, and it's the reason the stock is struggling to hold the $7 mark today, despite that positive news. The market doesn't trust the company's forecasting. The expectation is that new contracts equal a rising stock price. The reality is that just 1 quarter ago, in August, BBAI management shocked investors by aggressively slashing full-year revenue guidance and completely withdrawing its profit outlook, blaming disruptions and uncertainty in U.S. Army contracts. That event caused a catastrophic drop. So now, the smart money, the desks at Interactive Brokers and Fidelity, are not looking at the new O'Hare contract as a catalyst. They are looking at it as a small data point, and they are holding their breath for the upcoming third-quarter earnings report. The real battle for BBAI isn't about winning new projects. It's about proving it can actually predict, manage, and profitably execute the ones it already has. The disconnect between the exciting AI story and the messy financial reality is where all the risk and all the opportunity are concentrated. Let's break down this tension in the current trading. Technically, the stock is in a precarious position. It's trading below its 20-day moving average, and the MACD indicator is flashing a sell signal, suggesting short-term momentum is negative. This is what the day traders on Robinhood's stock trading platforms are seeing. However, the stock is still holding firmly above its 50-day moving average, and the long-term 200-day moving average is also supportive. This creates a muddled picture. The short-term trend is weak, but the long-term trend is still technically bullish. This is the chart of a Battleground stock. It's stuck between the technical sellers and the long-term accumulators. This isn't a clean setup like you might see in a blue-chip name like Apple stock. This is a knife fight in a phone booth, and the $7 level is the dividing line. The stock's average true range is high, confirming this is a high-volatility name not suited for a set-it-and-forget-it intelligent portfolio. It demands active attention. What's fascinating is who is participating in this fight. The expectation is that BBAI is a retail-driven stock. The reality, when you look at the 13F filings, is that this is an institutional favorite. The two largest holders are Vanguard and BlackRock. While much of this is passive index inclusion, such as in Fidelity ETFs or SoFi ETFs that track small-cap tech, the active side is just as interesting. Major quant funds and hedge funds like Citadel, Renaissance Technologies, and Millennium Management all have positions. Filings from mid-year showed a massive influx, with over 200 institutions increasing their positions versus only 70 decreasing. This tells us that sophisticated investors are looking past the short-term volatility. They are running models on their advanced Interactive Brokers platform that suggest the stock is mispriced, likely betting that the Q2 guidance cut was a one-time rip-the-band-aid-off event. They are in this for the fundamental story, not just the chart. This is the level of online investing that goes beyond just buying a stock because it's in the news. Now, let's look at the analyst community, because this is where the expectation versus reality disconnect gets truly strange. The consensus rating on BBAI is a moderate buy, or even strong buy, depending on which investing sites you check. That sounds great. But the reality is the average price target from these same analysts is around $5.83 per share. That is significantly below where the stock is trading right now at over $7. This is a rare and confusing signal. You have analysts at firms like H.C. Wainwright with an $8 target, but others like Cantor Fitzgerald with a $6 target. What this tells us is that the analysts who cover the stock are just as divided as the traders. They believe in the long-term story, hence the buy rating, but they cannot justify the current valuation based on the numbers they have today, hence the low price target. They are essentially saying, we believe the company will grow into its valuation, but right now it's expensive. This is a critical piece of investment help that many retail investors miss. Let's drill down on what BigBear.ai actually does. The company provides AI-powered data analytics and decision support tools. They specialize in sifting through massive, complex data sets to provide proactive intelligence to their clients. The business is split into two main segments, federal and commercial. The federal side is the core of the company, serving the Department of Defense, like the Army and Air Force, and the intelligence community. This is where they get their high-profile, sticky contracts, like the new O'Hare deployment. The commercial side is the growth story, where they try to sell similar tools for supply chain management, logistics, and healthcare. The expectation has always been that BBAI would use its government credentials to rapidly expand into the much larger commercial market. The reality is that this has been incredibly difficult. The sales cycles are long, and they are competing against a field of established players. The Q2 disaster was a federal-side problem, which spooked the market because it threatened the one stable part of their business. This brings us to the future outlook, which hinges entirely on the upcoming earnings report. This is the catalyst. The market is not going to be impressed by revenue growth alone. They've already seen that. The market is looking for one thing: profitability and predictability. Can the company post a positive adjusted EBITDA? Can they show margin expansion? Most importantly, will they issue new, reliable guidance that management can actually hit? The consensus estimate is for a loss per share around 33 cents for next year, a significant improvement from the loss of over $1 this year. If BBAI can show a clear path to that improvement, the stock will likely react very positively. If they miss on margins, or, even worse, offer vague or weak guidance again, the institutional support will evaporate, and the $5.83 analyst target might look optimistic. This is the binary event that many investors using Fidelity Wealth Management or other advisory services are being warned about. It's a high-stakes bet on execution. Comment below what you think is the single biggest risk for BBAI right now. Is it management execution, or is it the government budget chaos? Let me know what you think. This risk profile makes it a very particular kind of investment. It's not a safe haven asset. It's not something you buy in your Fidelity IRA and ignore for 20 years. It is a speculative, high-growth, high-risk asset. It's the kind of holding that can add significant alpha to an aggressive individual brokerage account, but it can also inflict significant pain. It's the polar opposite of a broad market Fidelity mutual fund. Even comparing it to other AI plays is difficult. NVIDIA stock sells the picks and shovels. Tesla stock sells a high-margin consumer product. BBAI sells complex, long-cycle, project-based solutions primarily to one client, the U.S. government. This is where they get their high-profile, sticky contracts, which makes its revenue lumpy and hard to predict, which the market hates. When investors look at this on their Fidelity mobile app or their SoFi trading platform, they need to understand this context. The company has outperformed Palantir and C3.ai over the last 6 months, but that was from a much lower base and was fueled by a hype cycle that is now cooled. The stock is now in a show-me state. The O'Hare news is nice, but it's not the $100 million plus contract that would fundamentally change the numbers. The path forward for BBAI is to stack dozens of these smaller $5 to $15 million deals, execute them profitably, and slowly transition its revenue from services to higher-margin software. This is a slow, difficult grind. It's not the explosive growth story many believe it to be. So, to summarize the $7.08 price you see today, the market expects this to be a simple high-growth AI story. People who engage in self-investing see the ticker, see the news, and they buy. The reality is that BBAI is a complex, volatile government services company haunted by a recent history of broken promises. It is now trading below its short-term moving averages and below the average analyst price target, suggesting the smart money is skeptical. However, the deeper reality is that large, sophisticated institutions have been building major positions, betting that the Q2 fumble was temporary and that the long-term value is intact.